This video continue to discuss on operating cash flow. This is a continuation of my earlier video 120. Why this video? We are going to discuss 10 dangerous red flags in financial statements with respect to operating cash flow. Second topic is tips to analyze financial statements from the point of view of cash flow in a business. The third one is a comparative statement of 3 cases to show how the operating cash flow improves. We have my video number 120 discuss the following aspects. One is the activities based on which cash inflows and outflows happen in a business. Format of operating cash flow statement. Analysis of cash flow statement. Preparation of indirect cash flow statement. And we also understood a case study with observations based on numericals. Please remember, profit shows performance. Cash flow shows survival. Profit may impress investors. Cash flow repays bankers. If profit grows but cash does not grow, investigate the profit. In credit appraisal, bankers don't trust profit. They follow the cash. Remember, financial statements may tell a story, but cash flow tells the truth. 10 dangerous red flags in financial statements with respect to cash flow. 1. Profit rising but cash flow falling. Debtors growing faster than sales. Inventory piling up without matching demand. Heavy dependence on other income. Other income means income from sources other than the core business. Profit boosted by one-time exceptional income. Borrowings increasing despite good profits. Frequent changes in accounting policies. Auditor giving qualified or cautionary remarks. Large related party transactions. High profit but very little tax paid. 1. Continuous increase in borrowing despite profits. If the company reports good profits but borrowings keep increasing, question arises, where is the cash generated from profit going? It may indicate cash flow stress. 2. Large exceptional income. When profits are boosted by one-time exceptional income, sustainability becomes doubtful. Example, sale of land, insurance claim, settlement income. Bankers should exclude such income while assessing the repayment capacity. Third, heavy dependence on other income. If a major portion of profit comes from other income, the core business may be weak. Example, investment income, asset sale, one-time gains are examples. Inventory growing abnormally. If the inventory grows much faster than sales, it may indicate slow-moving stock, obsolete stock, overproduction to show higher profit. Debtors increasing faster than sales. Compare sales growth versus receivables growth. Red flag example, sales grows at 15%, whereas the debtors increase by 50%. This may indicate poor collection efficiency or artificially inflated sales. 6. Profit rising but cash flow not rising. If net profit increases but operating cash flow remains weak or negative, it indicates that profit may be only on paper. Possible reason could be excess credit sales, delayed collections, accounting adjustments. 7. Verify related party transactions. Profit may be manipulated through related party dealings. Examples, inflated sales to related entities. 8. Compare earnings before interest, taxes, depreciation, and amortization margin with industry. If margins are unusually high compared to industry, investigate further. The possible reasons could be under-reporting expenses, improper inventory valuation, aggressive revenue recognition. 9. Compare profit with operating cash flow. Check whether the operating cash flow is consistent with reported profit. The red flag would be profit increasing, but cash flow from operation is negative or stagnant, meaning profits may be coming from credit sales or accounting adjustments. 10. Loan repayment requires cash, not profit. Bankers are repaid from cash generation, not accounting profit. Therefore, lenders examine operating cash flow, DSCR, cash accrual, etc. 11. Profit does not show capital expenditure. Profit statement does not show large cash spending on assets. Example, purchase of machinery rupees 2 crore. Profit may still appear healthy, but cash balance may reduce drastically. 12. Working capital changes affect cash flow. A profitable company may still have negative cash flow due to increase in inventory, increase in receivables, or reduction in creditors. This is why cash flow analysis is essential in credit appraisal. 13. Cash flow reflects liquidity. Cash flow indicates the firm's ability to pay obligations like wages, suppliers, interest, loan installments. Bankers, therefore, focus more on cash flow for repayment capacity. Now, there are three cash flow statements. In the case number 1, cash accrual was rupees 3816 lakhs, whereas the operating cash flow was only 211 lakhs. In the case 2, cash accrual was 3816 lakhs, whereas the operating cash flow improved to 2819 lakhs. This improvement is due to reduction in current assets such as traders, raw material, stock in process and finished goods, and increase in trade creditors. In case number 3, trade debts increased to 2955 lakhs from 2897 lakhs. However, substantial increase in trade creditors improved the cash flow from operating activity to 38.16 lakhs, almost equivalent to the cash accrual. Now, if you look at the thank you all. I shall come out with such small videos on learning topics. Subscribe to my YouTube channel, NPI's Learning Modules in Learning, and click the like button, which enables you to get notifications whenever a new video of mine is uploaded. Follow me on Facebook or on